Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, Amazon erasing $178 billion in market value today as its earnings disappointed Wall Street. We've got full coverage ahead. Plus, Apple seeing strong revenue growth amid increased demand in China. But those shares turning lower as well. We'll discuss the latest results and what the company had to say on tariffs. And President Trump's trade deadline has arrived. We'll break down who's facing higher tariffs and what the impact will be on the global economy. All that and more coming up on Catalysts. Let's get a check of the markets first here this morning. We are seeing losses deepening here this morning. Now, initially, when we got jobs numbers this morning that came in worse than estimated, and we saw dramatic revisions for the prior 2 months, we initially saw a little bit of relief in the markets on the thought that maybe the Fed will be more aggressive with cutting. But that sentiment seems to have dissipated as market participants wrap their heads around the idea, the possibility that the economic backdrop is worse than they had anticipated. Right now, we've got the Nasdaq down 2.5%, the S&P down by nearly 2%, and the Dow down 760 points or 1.7%. How is this playing out in the bond market? Let us take a look. We are seeing a dramatic drop in bond yields as well today, as we are seeing an increasing likelihood being priced into the market of cuts from the Federal Reserve coming in September and beyond. But if the reason for those cuts is that the labor market's weakening, market participants not necessarily happy about that on the equity side. The 10-year yield right now down 11 basis points, 4.25%. Let's get to our other big story of the day, and that's big tech. Amazon shares under pressure as its AWS growth failed to impress the street, and CEO Andy Jassy's response to analyst questions on the subject during last night's call, well, that didn't help boost investor confidence.
We have a meaningfully larger business in the AWS segment than others. I think the second player is about 65% of the size of AWS. The results over the last number of quarters, there's some times where as far as we can tell, we're growing faster than others, and sometimes others are growing faster than us, and it's still early. I mean, how often do you have an opportunity that's $123 billion of annual revenue run rate where you say it's still early? It's a very unusual opportunity that we're very bullish about.
Joining me now with his take on Amazon standing in the AI arms race is Brad Erickson, RBC Capital Markets equity analyst. Brad, it's good to see you. Did you find that Jassy was too, maybe not dismissive, but a little too casual about the concerns that the street's expressing? Do you think Amazon's gotten a little complacent?
Generally, yes. He had kind of a tough conference call, we'll say, or the company had kind of a tough conference call, to put it lightly. I think, they just didn't really address the fact that there is a large and frankly, this quarter, growing gap between the growth rates of AWS and particularly, Microsoft and Google. And I think, to put a sort of more particular point on it, he spoke about, other companies, mostly meaning Microsoft, benefiting from training revenue. A lot of that is intended around OpenAI, and Amazon does not have OpenAI as a customer. They have Anthropic, which is a positive force, but it's not nearly as big as what OpenAI is doing. And so what he's saying is as more developers start to use other platforms, say besides OpenAI over time, they will benefit from that. We believe that to be true. The problem is the optics of how that's sort of, outputting into their financials right now is just not great. And so that's the issue for the moment.
And I guess it's also a timing issue, right, Brad? Like, at what pace do you think that will start to happen?
That is the $1 trillion question, or what did you say, $187 billion question this morning. I think the issue is, and we all, the analysts that cover the stock, all spoke with the company afterwards last night. They're not really giving us good indication that it's coming in the next even quarter or two. What we're looking for is acceleration, right? They grew 17.5% last night on the revenue of AWS. I think investors are looking for something probably that approaches 20% over time. We think that's probably a next year type of thing, which is fine. You can hold the stock here and play for that, but you're probably not going to get it for a little while.
And you ask in your note in reaction to the earnings whether the changes we're seeing are structural here. What would be your best guess at the answer to that?
Yeah, I mean, like a lot of things, we can make the argument both ways.
Right.
If we think they are having structural issues, it's just again that Microsoft is capturing so much of OpenAI's development as well as those using, OpenAI's models and others that could flow through Azure, and that Amazon just isn't going to capture that as much over time. That's the negative argument. The more optimistic view is just that, hey, look, again, OpenAI has that huge lead. Everybody's aware of that. But we know that these models are going to commoditize over time. The developers are going to use a lot of different kinds of models. That's actually what the most attractive part of AWS's platform is they're going to have probably the most models, kind of a menu of models for custom use by whatever companies want to use. We think that's really compelling over time. We actually think that's how it plays out, but that's the more optimistic view.
So, Brad, as you know, the company spent about $31 billion on CapEx in the quarter. We've obviously seen all of these hyperscalers increasing their CapEx, but the reactions have clearly been very different. So,
yes.
I mean, this is sort of a different way of talking about what we've been talking about, which is, Amazon's return on investment. How are its signals different from what we heard from, say, Meta or Microsoft?
Yeah, $31 billion, shocking number for the quarter. It's actually quite simple. So Meta and Google both saw significant or nice acceleration in their revenue growth. And that gives you cover, what I would call cover, where investors will bless spending more money on CapEx. And that's what happened. Amazon did not accelerate growth. They grew basically roughly in line with what they grew last quarter. Their backlog increased, but actually the dollar increase was actually not great. It was the least amount of dollars in a year that they added to their backlog. So not accelerating, not great backlog growth, and they're spending more. That doesn't reconcile for investors. That's a problem.
I do want to ask you one question, at least, about the other part of the business, the other small part of the business, all the stuff they sell to people.
There's another part of it?
Yeah, right. How's the consumer holding up? How's Amazon holding up in your view? Is that the sort of ballast here?
Yeah, sorry, it's nice. Thanks for asking, because now we don't have to sound so negative. The other part of the business is actually, I would characterize it as firing on most or all cylinders. They beat on revenue. They significantly beat on margins. So they're really showing they can run this more and more profitably. And they're not really seeing issues from the consumer perspective. I think the debate there, or kind of the issue going on, right, is that they clearly bought inventory, a lot of inventory, as much as they could ahead of kind of a potential tariff switchover. And a lot of the third-party suppliers or companies that sell products on Amazon did the same. Those inventories are depleting. We think they will probably deplete by sort of the end of Q3. And so there's uncertainty as to what happens. Now, I'm not going to espouse an opinion on August 12th and what happens with China and the US, but assuming we sort of stay in this holding pattern for a period of time, prices will have to start to come up probably a little bit, so that demand destruction risk enters the equation. But I would tell you that we've seen this with Meta, we've seen this with Google, and I think it's the same with Amazon. They have so many sellers, millions of sellers, that when one seller has, outsized supply chain exposure to China and forces it to increase its prices maybe more than competitors, there's somebody else to fill in, often with a substitute product at the same price. That's one of the key factors of why they probably benefit more than others or see less adverse effect from the tariffs.
Yeah, and at the end of the day, people want their stuff wherever it's coming from. Brad Erickson,
right.
Great to see you. Thanks for joining us.
Good to see you. Thanks a lot.
Meantime, we've got Apple reporting its biggest quarterly revenue growth in 3 years, boosted by iPhone strength and demand in China. Joining me now, Tom Forte, Maxim Group Managing Director and Senior Consumer Internet Analyst. Tom, we're just looking at the shares, and they've turned negative now. Do you think that has to do with the sort of other factors this morning between trade and the jobs report, or is there something in Apple that investors are now paying more attention to?
Sure. So if I was to go glass half empty on Apple's results, Tim Cook indicated that the tariff impact originally expected to be 900 million in the June quarter, ended up being 800 million, is projected to grow to 1.1 billion in the September quarter. And while it's encouraging that the company is making efforts to catch up on artificial intelligence, including spending more in CapEx, I call it 3 billion a quarter instead of 2 billion a quarter, and even Apple's open-minded to strategic M&A to close the gap, it's still behind the 8 ball or lagging from an artificial intelligence standpoint. So I could see the stock being flat today on those concerns.
At the same time, as you said, a lot of the numbers here look pretty good. I mean, did you find the iPhone sales in particular reassuring, especially since the company said that not a lot of it, I think they said 1 percentage point of the gain was accounted for by pull forward from tariffs. The rest of it was just people wanting iPhones.
Yeah. So if you looked at the double-digit revenue growth in the June quarter, Tim Cook ascribed 100 basis points or 1/10 to consumers in the US in the month of April buying iPhones and Macs ahead of potential tariffs. So I guess is the question, 1% growth out of 10% growth, is that a small number from a pull forward standpoint? Perhaps. Again, if you look at, so glass half full in the quarter, they had revenue growth again in China for the first time in a while, despite very significant competitive pressure. Their outlook for revenue in the September quarter was favorable. So if you can set aside the incremental tariff impact, their revenues exceeding expectations, and then their services is performing reasonably well also.
Tom, let's dig into the AI question, because you and I have talked about this before. And our tech editor, Dan Halley, has sort of posited that the whole AI thing is more of a Wall Street concern than a consumer concern. And stick with me for a minute here. When I buy an iPhone, I don't really buy it for the stuff that it can do. I buy it for the design of the hardware, right? And so in the future, won't we just be using apps for AI anyway on the iPhone? In other words, why is it so important for the phone itself to have those capabilities?
Yeah, so I'll pick the best example, but I have to be careful because every iPhone device or Apple device in my is going to go off. But if you think about Siri as an example, so we now have more information on the timing for using artificial intelligence to upgrade Siri. It's expected calendar next year, so it's at least 12 to 18 months late. And then this holds true for Alexa for Amazon, meaning that in the future, if consumers are looking for a digital assistant, will it be Amazon's, will it be Apple's, or will it be OpenAI's? So how functional or how important is your smartphone in the future if the main primary features or the things you value most are not necessarily coming from Apple? I think that's a challenge.
Well, but how would you access those things, I guess, is the question. Like yes, your Alexa, you got your, whatever your device is at home, but you don't carry something with you typically that has Alexa unless you access it through your phone. OpenAI right now, you get to it through your phone or your device, right? So in other words, are you seeing a near future where these other companies will also have other ways for us to access it?
Yeah, so the concern is, from a dislocation standpoint, when does the smartphone become less instrumental to a consumer's experience with the internet or with technology? And I would say that so far, the shelf life or the product life for smartphones has been incredibly robust and incredibly long-term. But I guess the question is, we talk about the Internet of Things or things of that nature, but what happens when you interact with the internet in your car or you interact with the internet on perhaps a smart TV, devices that aren't your smartphone? How significant will Apple be in the future? And really what's driven the stock for the last 12 to 18 months, perhaps 2 years, is the services revenue growth. Well, what happens to the services revenue growth for Apple if hardware sales not only stagnate but decline? And I think that's a big long-term concern that investors have for Apple.
Now, Tim Cook did say on the call that they're sort of cognizant of a post-smartphone world, right? Like maybe it's glasses, maybe it's something you wear around your neck, maybe it's a chip in your brain, I don't know. I mean, did you find that reassuring at all?
I found it reassuring because he said it in a manner to suggest, Julie, that they're working on things that he didn't want to highlight. Meaning that, so Apple could have a smart ring, or Apple could have maybe not the Neuralink brain chip, but Apple could have all those products consumers may use in the future to interact with technology and to access the internet, things of that nature. So the manner of the way he said it suggested to me that Apple's working on things, and I think that's good when the day comes and the smartphone's less, significant.
We will look ahead to that day. I don't know about look forward happily, but we'll anticipate that day. Tom, good to catch up with you. Thank you.
Thank you, Julie.
Coming up, the White House unveils an updated round of reciprocal tariffs. Find out which countries face the highest rates next. On Thursday, the White House released a slew of adjusted tariff rates for U.S. trading partners ranging from 10% to as high as 40%. The new rates will mostly take effect on August 7th. Here with me now, Yahoo Finance correspondent Ben Worschel and Jeanette Lowe, Strategas Securities Managing Director of Policy Research. Ben, I want to start with you. Set it up for us here. What changed overnight in terms of where these tariff rates are landing?
Yeah, a lot to go through here, but we had kind of three areas that I think were surprises in terms of what we were expecting going into last night. This all kind of came out late last night with a lot of data here. The first one is this 7-day delay that you mentioned, where we were expecting a lot of these rates to go into effect right now. Canada is in effect right now. They jumped from 25 to 35%, but the vast majority of these have a 7-day delay. The White House says that's mostly about logistics more than anything else, but it also means clearly there's going to be a lot more negotiations over the next 7 days as countries that aren't happy with the rate they saw try to get that lowered in this 7-day window. Second is that over 100 nations are staying at 10%. These are mostly much smaller trading partners, but it comes after a lot of signals of 15% as kind of a new global minimum, which clearly isn't the case for at least for these countries. Elsewhere, there is a clear convergence towards this 15% number. The totals here are about 120 nations now at 10%, 40 nations at 15%, and then 30 nations higher than that. And in that 30 that are higher than that, we do have a few surprises that I think are notable. Switzerland is getting a lot of attention this morning. They have a 39% rate that was announced last night. This is very significant for them because they're, competing with the European Union that has a 15% rate. So that's going to be a real challenge for them. So they're going to be reached out of that for certain. Another one that jumped out to me is Taiwan, which has a 20% rate. This will be adjusted on the semiconductor front, but it's another clear grouping of a bunch of Southeast Asian nations in the 19 to 20% range, kind of in China's orbit. So those are the top lines for certain.
So, Jeanette, let's bring you into this. The market seems a little bit surprised by some of this. Were you surprised? How do you think this comports with what the expectations were around this whole situation?
Yeah, I mean, I think there were obviously some surprises. I think the Switzerland rate obviously would be a notable one. But again, that adds pressure to try to get a deal since there already had been a talk. There had been a framework that had been passed between the two sides. So some of these pieces are a push, and they were a little bit more aggressive than maybe the market had been anticipating. And I think that's going to kind of play out over the next couple of days, and we'll see where that lands. I think that overall, though, if we looked at all the rates and kind of how it ended up, these higher rates had been forecast over a month ago, so we've had some time to kind of digest it. And overall, when we looked at the numbers, you did have Switzerland coming in at 39%, but then at the same time, you had Thailand and Cambodia's rates coming down significantly. So that is important. So overall, it kind of netted out to about the same of what we've seen before. But overall, that means we've had about $100 billion tariff increase than we had before the tax bill was enacted, but it hasn't gone up significantly more than that. And I think that is important because we had looked at some of the rates and they could have actually come in even more aggressive had there not been these trade deals. They're still much higher than obviously we had before April 2nd, but overall we're kind of at a level that's a little bit easier to maintain. The tax bill has the ability to sterilize the effect of some of these tariffs, though of course one big caveat is that we still could have more sectoral tariffs down the pike.
I mean, Jeanette, tell that to the job market. I mean, the numbers this morning, as well as the ISM Manufacturing numbers we just got, seem to show that the U.S. economy is perhaps not taking this in stride as much as people have been banking on.
No, I mean, absolutely. I think what investors were looking for before we got the jobs report was that they were looking for more certainty with regards to the tariff rates to be able to make decisions. I think having the tax bill also done does help out because it allows companies to now make decisions about whether or not they might make future investments or not. But obviously, there is weakness in the job market, and that's something that is not discounting that at all. But that is something that I think if you look at where perceptions were of some of these the headlines, we tried to look at what actually occurred. And even though you might see something like 40% rates on certain countries, overall, the level of tariffs is about the same as it was earlier this week.
Right, although still way above where it was, a year ago, for example. Ben,
exactly.
Any more indication that we do have the delay to August 7th of these going into effect, but it seems relatively certain that they will go into effect, right? Are there any indications coming from the administration that could get pushed back even further? And we're still, by the way, waiting for confirmation of a delay on China, right?
Absolutely, yeah. So no confirmation of a delay. It is significant that these orders have been signed by executive order. So basically, nothing else happens now, these rates go into effect. I do think, as I mentioned before, there's going to be a lot of negotiations between, so there might be wiggle room there. But all signals are go that this is going to be the new rate on August 7th, unless further action is taken. And on the China point you mentioned, the deadline there is August 12th, so that comes a few days later. So we are still waiting for word there on whether there's going to be another 90-day delay. Treasury Secretary Bessent has been meeting with Trump this week to talk about it. We don't have any indication of which way the president is leaning there, but the signs have been that there is another 90-day delay, and potentially in the offing to kind of push that further into the fall.
And Jeanette, there's also yesterday, U.S. Court of Appeals heard arguments against these tariffs. What do we hear in those arguments that would help us understand whether this legal challenge could potentially block some of the tariffs?
Yeah, I mean, you definitely heard some skepticism amongst the judges as to whether or not the International Emergency Economic Powers Act, which is the authority that Trump used to impose the tariffs on reciprocal goods and on Canada and Mexico and China, whether or not that is a good legal basis for imposing tariffs. One of the things we're going to be obviously watching is when that decision comes out, potentially later this month, what does it look like? Is it a strong ruling? Is it almost all of the judges potentially saying that they disagree with the use of IEEPA to impose these tariffs and strike them down? That would be important. I think the markets would obviously move on that, thinking that these tariffs could be taken off. That case then still might go to the Supreme Court, but if there's a really strong decision, it also might make the Supreme Court unwilling to rule for the administration. And so that means there could be the risk either of these tariffs coming off in the immediate term, but then there's also still backup plans from the administration. So even if the tariffs were to be ruled out of order from the courts, that doesn't mean that there aren't a backup plan to impose tariffs through Section 122 or Section 301. You do see that this is Trump's overall agenda, is to have a 10 to 15% tariff rate universally applied. And I think that is what is something that he is going to be looking to do, even if there might be some legal setbacks in the near term.
Yeah, so markets should probably get used to it. Ben, Jeanette, thanks so much for joining us. Appreciate it. Coming up, we've got a read on the health of the manufacturing sector as new tariffs go into effect. And after we got that read, we are still seeing stocks down sharply. This is the biggest move that we've seen, the first move we've seen of at least 1% in more than a month's time. Right now, the Dow is off about 1.2%, 514 points. The S&P down 1.4%, and the NASDAQ falling by nearly 2%. We'll be right back. Manufacturing activity fell in July by the most in 9 months as tariff-related uncertainty continued to rock the sector. It was the 5th straight month of contraction. Here with a deeper look into the sector is Thomas Derry, CEO of ISM, the Institute for Supply Management. Thank you so much for being here, Thomas. These numbers, sort of coupled with the jobs numbers this morning, show an economy that's really being affected by these tariffs. Is that the right way to read it?
I would say yes. I mean, getting below that number, that headline composite number for a minute, 76% of manufacturing was in contraction in the month of July, which is the highest reading we've had since December of 24. So that is a concern. And 31% of manufacturing was in strong contraction. In fact, of the big 6 manufacturing sectors in the United States, all were in contraction and none expanded in July. In June, 4 were expanding. So I think we've gotten to a sort of a low point, right? We've had some major announcements on trade deals this past week. We'll see if that eases concern, if it's interpreted as more stable and predictable conditions are being created for trading with our major partners. That would probably be a positive thing in the minds of most U.S. manufacturers. But yeah, the numbers this month were quite weak. Although I would say that there are some positive signs for the future potentially. I would point to a slower decline in new orders, a slower decline in backlogs, an actual increase in production. And now, with the jobs report this morning and speculation that the Fed will have to cut rates in September, that would also be a positive support for the manufacturing sector overall.
Thomas, I know that a lot of folks, yourself included, have talked about the stability, wanting some certainty with tariffs. But if the certainty includes things like a 50% tariff on steel, I mean, is that helpful, or is that just going? I mean, is that just going to more permanently depress activity?
It could. I mean, the administration's rationale for imposing tariffs tends to shift, right? Once it was about the trade deficit in goods. Once it was allegedly about raising revenue for the federal government to help pay for the big, beautiful bill. And more recently, of course, like in the case of Brazil, it's been purely a political response to situations that the administration doesn't like. As long as that is a possibility, people are going to be cautious. And that's what we're seeing more than anything, is a very cautious outlook from the manufacturing sector. Employment contracted again in July, even though production ramped up. So companies are being cautious because they don't know what to expect.
The tariffs are also, in some cases, as you said, the rationale shifts. But one of the ongoing themes is that this is aimed at helping reshore manufacturing, helping give a leg up to U.S. manufacturers. Are you hearing from your constituents that in any cases that is the case, that it is helping them?
Quite a few are commenting about reshoring and nearshoring, and that has been one of the active strategies for sure. Some of the other strategies aren't really available. I mean, in the first iteration of the Trump administration, you could look for tariff-exempt countries and look to source from there, but there really aren't tariff-exempt countries anymore. So reshoring and nearshoring becomes a more feasible strategy for companies than it has been. Now, in many cases, unfortunately, capacity doesn't exist in the United States for certain sectors yet, and will only be created over time. But I think momentum will build, and we'll see some of that capacity return to the United States.
And lastly, I'm curious about the employment picture as well from your constituents, because I know that there was also a decline in employment. Talk to me about that, and also how the immigration picture is feeding into that.
Yeah, it doesn't help, right? The ICE raids are problematic, I think, for a lot of companies, especially smaller companies, especially sort of in the Midwest of the country. And that factors in. More than anything, though, companies, people tend to be a fixed cost from a manufacturer's perspective, and labor is a huge component of manufacturing cost inputs, cost of goods sold. So they're cautious on employment right now. They're not backfilling open vacancies. It was a different story during the pandemic when there was a high degree of turnover and people were actively looking to hire people and keep up with the amount of work that existed. Right now, because they're conservative about the outlook, they're being very conservative about making employment decisions now. This morning's non-farms payroll report was very weak, as you know, and it'll be interesting to see how manufacturers respond to that and whether they feel like I need to be active in filling my open positions because there's an opportunity for me to strike, and that could help.
We shall see. Thomas, thanks for your perspective. Appreciate it.
You're welcome.
We got more markets action coming up. Stay tuned. You're watching Market Catalyst. Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ. Let's get a quick check on the market action about 1 hour into today's trading session. We're seeing all major indices down more than 1%. This is the first time this has happened since June, after a monster July was really led by AI earnings. Now, based upon weaker jobs data from July, as well as those latest
trade headlines coming from President Trump late Thursday evening. We're seeing all three major indices in the red. If we take a closer look, the Dow down more than 500 points, down nearly 550 points as we make our way into today's trading session. The Nasdaq also experiencing similar pressure there, down more than 1.70%, down about 370 points. And once again, if you take a look year to date, this is a difference where you can see the tail end there. We're dropping off a bit after those record highs that we saw just last month. The S&P also under similar pressure, down nearly 1.4%. And once again, this is largely based upon that jobs report that we got this morning at 8:30 before market open that not only showed weaker than expected jobs data for the month of July, but we also got a revision for the June jobs report to 14,000 jobs added, down from 147,000 jobs. So certainly some fear there as well. And of course, those trade line headlines also hitting stocks today. We know if we take a look at the retail sector, some of the biggest stocks that I'm seeing decline and watching it is coming from Nike as well as Lululemon and Deckers. Deckers down the most, down about nearly 3% in these early hours of trading here. And what we know is that not only is that China headline there set to go into effect not until August 12th, as a potential pause may be on the table here. We're still waiting to hear more on those China-U.S. trade negotiations. But what we do know is that the trade headlines announced last night, which range between 10% to as much as 40%, with Switzerland facing a 39% tariff. What we do know is that now they have about 7 days, so negotiations can still happen, but we're seeing lots of red today. Once again, down more than 1% across all three major indices. But keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout today's trading session.
Time for some of today's trending tickers. We're watching Reddit, Fannie and Freddie, and Fluor. First up, Reddit shares surging after projecting strong advertising numbers. The social media site also posted its most profitable quarter to date. Reddit's been investing in ad tech, hoping to grow its share of the digital ad business dominated by industry giants like Meta and Alphabet's Google. While advertising still drives the vast majority of sales, the company also has data licensing deals with OpenAI and Google, and it's seeking more. Next, mortgage giants Fannie Mae and Freddie Mac are jumping today on reports that President Trump is bringing in bank leaders to meet with him one-on-one at the White House. Trump is asking chief executives for their pitches on monetizing the mortgage giants, including a major public offering of stock. That's according to Bloomberg. Trump said in May he's giving very serious consideration to bringing Fannie and Freddie Mac public. The companies have been under government conservatorship since the 2008 financial crisis, but small portions of the stock already trade publicly. Finally, Fluor sinking after the infrastructure construction company cut its adjusted profit guidance for the full year. Second quarter results coming in well below Wall Street's expectations. The company's new outlook also falling short of the average analyst estimate. The company's share declined today, the biggest drop since 2020. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, all your markets action, you're watching Market Catalysts.
Chair Atkins, thank you so much for sitting down with me. It's wonderful to have you on Yahoo Finance.
Thank you very much. It's great to be here. I think this is my first time on Yahoo Finance.
And hopefully the first of many appearances.
I'd be happy to come back. Thank you.
The President's Working Group on Digital Assets has directed the Securities and Exchange Commission to immediately enable the trading of digital assets at a federal level, specifically asking for greater clarity on trading, custody, registration. Could you offer more details on what we could expect to see in terms of customized rules for crypto from the SEC?
Well, thank you. That's a great topic, and I could go on for hours on that one, but because it's complex, and we are taking a new path than what's been done before here at this agency. But basically, what we've done is establish a crypto task force, and that started back in as soon as inauguration happened with my colleague, Commissioner Hester Peirce was leading that. And so now we are formalizing that task force into what we're calling Project Crypto. So mobilizing the full extent of the SEC's staff here in the various rulemaking divisions to start putting together proposals to go to the public and make proposals as far as making rules more streamlined and fit for purpose with respect to the crypto world. So it stems from initial registration and how intermediaries are registered or not, and how they can deal with crypto assets.
During the last administration, I heard routinely from crypto companies how difficult it was to just merely register with the SEC. How could we see that change? What does the path to registration look like for crypto companies? Can you offer any insight into how that would change?
Well, I think the trouble was in the past, the SEC didn't make any accommodations for things that clearly don't fit with respect to either a crypto company, crypto-related company, sort of like a broker-dealer equivalent, one who's trading crypto assets, or the assets themselves. And so there are many questions, and it was just hard for crypto companies to shoehorn into a set form that's been around for decades and decades, so, kind of fit for purpose for an industrial era, but not necessarily for a digitized company or digitized asset. So we're out to make that, our goal is to make that clear, so there's no more question and people don't have to try to have their lawyers interface with SEC. The lawyers don't get any answers, so they can't give an opinion to their client as to how to go forward. So we want to cut through all of that and make things, very straightforward so that people have certainty. And so innovators need certainty in order to bring their products to market, because investors who are interested in investing in that innovation need to have certainty that everything is legal and that it's not going to get tied up in litigation or lawsuits or whatever.
What about the custody side? Can you offer any details on what changes we could see there?
Well, with that, we have a certain authority on our own with respect to investment advisors and whatnot. But generally, we will be working with our colleagues at the bank regulatory agencies and with the states to get some set rules down that then are consonant with the rules that apply that are in statute right now. We have authority to interpret those statutes to make them fit for purpose for the current environment. So I look forward to working with the bank regulators as being outlined in that PWG report.
And how quickly could we see these rules implemented? What's the timeline on this?
Well, we can do some things just through the normal course, but to make sure that things are stable for the future and not still in question, we will go out. We have to have rule proposals that go out for notice and comment from the public, and to make sure that we've gotten it right, which is just the best way to do things, obviously, rather than go ahead and shoot first and then ask questions later. We want to ask questions first and have people give input to make sure things are correct and there are no loopholes in it or whatever. So that process will take a while, so people shouldn't think all this will happen here in the next 2 months. But we're going to start. We've been working on this for a while. We'll be starting to roll out proposals and here this year in the next few months. And so it will proceed apace into next year and perhaps into the following year, but you'll start seeing things come out.
Last month, you said you're considering an exemption for innovations to help companies who want to experiment with moving stocks onto the blockchain. Subsequently, we heard from your colleague, SEC Commissioner Hester Peirce, who said in a statement that tokenizing a security creates a token that is a security. So could you offer a bit of clarity there? What can we expect if stocks are trading on the blockchain, are tokenized? Will securities laws that are still on the books apply?
Well, as Commissioner Peirce said, I mean, the way the law is written now, we'll see how that develops with Congress. But the tokenization of securities is a wrapper around the security itself. So that still, in most cases, probably would be a security. But we need to have, again, to get back to clarity, we need to have set out straightforward rules so that people can see, like, okay, is this a commodity? Is this a security? Mm-hmm. And then if it's a security, then what do I need to do to make sure that I can issue it and that it can be traded properly under the law? The blockchain adds so much advantages to some of the other aspects of the current financial system. But part of that is transparency, on the blockchain. You can follow the transactions back to inception. And so there's, because of that openness, I think we can use that as a lever to help, make sure that things are consonant with the securities laws.
So just to clarify, if a stock is tokenized, the securities laws that are still on the books would comply, would apply rather. Those stocks would still be governed by the current securities laws.
Right. I don't think that we'll study this and make sure that we can have a straightforward answer. But a lot of times, there are different ways to tokenize things, and so some of that will be you compare it to, say, a mutual fund or an ETF. So the ETF is still a security, even though it has securities also in it. It's a basket of securities. So that's the similar thing with a tokenized asset. And but we need to make sure that the rules that apply for disclosure and issuance and all that can accommodate, the special features of tokenization. And it's much more efficient, perhaps, to have a tokenized security than some other sorts of things. But we need to make sure that we have a level playing field, that people are certain how to go forward. So that's going to be unfolding as we address these issues.
Jennifer Schonberger, thanks to her for bringing us that interview. Coming up, we have full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst, first up, worrying signs in the labor market. July jobs missing estimates with downward revisions to prior months. We'll discuss. Plus, Coinbase sinking as its revenue disappoints. We'll break down the outlook for it and the crypto industry. And Exxon and Chevron topping estimates amid record oil production. We'll discuss that and much more on Market Catalyst. 90 minutes into the start of U.S. trading, I'm Julie Hyman, and let's get a check of the markets here. We continue to see a sharp sell-off unfold across the three major averages. We've sort of been bouncing around in a negative range here. Right now, the Nasdaq's near the lows of the session. It's off by 2.1%. The S&P 500 off 1.6%, and the Dow off nearly 600 points. That's 1.3%. We've got a combination of factors here today. Amazon's disappointing numbers dragging down that stock and the Nasdaq as a whole. The July jobs report disappointing, as well as new trade headlines also weighing on stocks. Let's zoom in on jobs now, though. The July non-farm payroll report coming in under estimates with just 73,000 jobs added in the month and sharp downward revisions to the previous two months. Additionally, the majority of the jobs added were in categories that have led the economy throughout 2025, healthcare and retail. Here with more is Corey Kentenga, LinkedIn head of economics in the Americas. Corey, thanks for being here. In response to the jobs report today, you wrote on LinkedIn, if you were hoping today's jobs report would offer clarity on the state of the labor market, you may be disappointed. But don't we have more clarity that things are not good?
Well, on the payroll side, we do see that things have been weakening and they're potentially much weaker than what we expected. But about half of those revisions came from government, which has been the Achilles heel of payroll growth since about January 2023. So we have a lot of payroll growth concentrated in just three industries: healthcare, government, leisure, and hospitality. And that has been a fragility in the labor market for the last 2 years. But what we also see in the jobs report is that unemployment is pretty steady. It's at 4.2%. So unemployment is not dramatically increasing, which suggests that even though we see weaker payroll growth, there is still some steadiness in the labor market. So these are really mixed signals that we're getting right now. So I don't think that today's jobs report provided much more clarity.
On the unemployment side, how much is the immigration picture contributing to that sustainably, the unemployment rate sort of staying relatively stable?
So if we look at labor force participation, or we look at the employment to population ratio, those measures have been pretty flat since the last year. Part of the thing that's contributing to that is the slowdown in migration that we have been witnessing. And part of that is also that it's just not as attractive to look for a job in the labor market, given that hiring is slow. So on LinkedIn, we saw actually a pretty sharp slowdown in hiring from May to June, down about 8 to 9%. And so with the slowdown in hiring, it's a much more challenging labor market. So even for workers who are already in the US, they don't necessarily want to spend a lot of their time looking for work because it's just so difficult to find it.
So the areas where we saw big decreases, we saw decreases in retail, we saw decreases in leisure and hospitality, we saw increases in things like healthcare still. But the places where we saw decreases, can we pin that on tariffs? Can we pin that on sort of economic weakening overall?
So it's hard to say right now. For a lot of the areas that have been weak, let's take manufacturing, for example, where there was a reduction of about 10,000 jobs in manufacturing. Manufacturing has been weak primarily because interest rates started bringing down hiring in manufacturing from about the spring of 2022, and it's been slowing down ever since. Even when we've seen some recovery in areas like technology, media, finance, and hiring on LinkedIn, manufacturing's continued to slow down. We also see that in the payroll numbers, and that is primarily interest rate driven. Of course, higher import prices for manufacturers is not helping the situation, but really it's hard to disentangle right now between high interest rates and impact coming from tariffs.
I mean, if you're looking at retail, for example, wouldn't that seem to be a little bit more of a, retail, one of the sectors that is the most exposed to tariffs because of apparel imports, for example. So wouldn't that be a more obvious place to look as well?
So retail is one of those sectors that's just been on the decline for decades now. So we've seen some boosts in retail employment sort of later in 2024. We did see some boosts. So there's potential chance that we're just sort of reverting to the mean for retail of what we would have expected to be had that long run trend of decline continued. So we would generally expect that if there is some impact from tariffs, if it's biting on the consumer, that you'd see some pullback in retail. But generally, it's really hard to sort that out between with retail, transportation, and logistics. We've had months where they've done very well. We've had months where they pulled back very strongly.
Okay, so what do we know then overall, Corey? I guess I am convinced then that it is a murky picture.
Yes, right now it is a murky picture when it comes to the labor market. We do know that things are pretty steady in the sense that unemployment seems pretty steady. Folks who are employed seem to be able to maintain their jobs. Initial claims are actually coming down, so layoffs are low. So there doesn't seem to be any signs of major distress that would raise unemployment. But we have seen that there's a slowdown in labor supply, meaning that we actually don't need to add as many jobs as we have in the past. So we should expect to see going forward payroll growth slow. The question is it too slow? And that's really where the lack of clarity comes in.
Okay, any silver linings here, Corey?
So the silver lining is that if you are working in an industry like healthcare, or you are potentially doing a role where there are opportunities in healthcare, you are still working with a very robust, very active labor market. That has been the case for the last couple of years. A lot of the jobs being added to the economy are happening there. On LinkedIn, we still see that for healthcare, hiring is pretty robust. It's about where it was prior to the pandemic. So that's really the area that's really supporting the labor market. So it's both good news and bad news. Bad news in the sense that the labor market is very fragile because it's supported by one sector, but good news in the sense that there is a sector that is pretty robust and is likely to buck some of the trends that we're seeing as growth is expected to slow later in the year.
Gotcha. Okay, Corey, thank you. Appreciate it.
Thank you.
You got all your markets action ahead. You're watching Market Catalysts. Farm machinery maker AGCO reporting better than expected results and raised its full year outlook. Still, the company is struggling with soft demand, especially in its North American business, which fell 33% from a year earlier in terms of revenue. Joining me now is Eric Hansotia, AGCO CEO. Eric, it's good to see you. Thanks for being with us.
Great to see you again, Julie.
I got to tell you, we talked to a farmer in Missouri who farms corn and soybeans last week. And his vibes were not great. And I'm just curious what you're hearing from your customers, or I should say your customers' customers, since you sell to dealers, about kind of what the sentiment is like out there.
Yeah, I mean, I was just in Illinois last week with a group of our customers. We were at we called it agronomy and autonomy. So we were showing, some of our latest technology and our autonomous solutions where you take the operator out of the cab. To your point, farmers are under a lot of pressure right now. We're at what we call the trough, so the very bottom of the business cycle, kind of the worst year in the business cycle. It happens like once every 10 years. we're there. We believe 2025 is the trough. And that's because farmers are under a real profit squeeze right now. The price they're getting for their grain is low, and yet their cost for their inputs is high. So their profits are squeezed. Now, they have a sentiment where they want to refresh their fleet. Their fleet is getting old. They're really excited about the new technology we're providing, about automating a lot of features, some autonomous solutions, and so on. So there's a thirst for buying, but there's caution, not only because of the profitability today, but because of the uncertainty with tariffs. What we need is for that uncertainty to clear up. And then we think on the backside of that, the market is going to come back. We're expecting 2026 to essentially be up in all of our markets slightly, not dramatically, but certainly coming off this bottom of the cycle.
So that sounds like you see a potential rebound in grain prices then.
Well, to some extent, we're at the bottom of the cycle. All of our forecasting models are predicting that things will come up a little bit in 2026. It's a little bit on grain prices, but also there's some good yields. When I was up in Illinois, that's some of the best corn and soybeans I've ever seen in my career, and I've been in this industry my whole life. So there's price times volume. Some of the farmers are going to get some good volumes, and just the value they get out of the new technology. We're automating features all the way around the crop cycle, from automated soil sampling, planting, spraying, harvesting. And these solutions make them more productive. Our mission is to have like a 1-year payback. So on the one hand, it's profitability. On the other hand, it's improvements to their business because of the technology.
Right. And we've talked a lot about that technology before. I guess the question is whether they have the liquidity at this point to invest in that kind of technology. It sounds like you think the outlook is better for that going into next year.
Farmland values are holding up. Used equipment values are holding up. So their farm balance sheet is very strong. We made this big move last year to pull together Trimble Ag's assets into our business. We created this new business called PTX, Precision Technologies Multiplied. We aim to be the most powerful precision ag tech company in the world, serving the mixed fleet, meaning not only our brands, but all brands of equipment, putting the technology on pieces of farmers' machinery that they already own and bringing new capability to that machinery across all brands. So we serve all farmers. That combined with our tech channel, that we're the only one who goes to market not only through our machinery channel, but a parallel tech channel that all they sell is tech. They don't sell tractors or combines or planters. They just sell tech. So that business is there to serve these farmers, to make them more productive, and the farmer balance sheet is still pretty strong. We're at a time here where not only is the industry bottoming and moving up, but AGCO has reformulated itself, changed our portfolio. We've moved the grain and protein business out. We've built this PTX business that I just mentioned. We've resolved our main issues with our main shareholder and gotten the TAFE issues behind us. That's clean now. So, and then we've adjusted our distribution strategy. We call it Farmer Core, where instead of having the farmer come to the dealer and through a brick and mortar relationship, we go to the farmer. Digital tools and on-farm solutions. We call that Farmer Core. And finally is this program called Reimagine. Using AI and other tools, we've taken $200 million of cost out, right at a time when the farmers need cost efficiency. Mm-hmm. So those 5 things coming together all at the same time have gotten the portfolio. We've got the AGCO we want. It's fundamentally different than the last business cycle. And it's showing up in our margins. We're essentially delivering margins twice of our last downturn.
And Eric, obviously, all of this are things you can control, but you can only control what you can control. So we talked about one of the things you can't control, which is crop prices. Although, to your point, maybe we're seeing a bottom here. The other thing you can't control is Washington. And I'm curious what the effect tariffs are having on the business when you've got things like steel tariffs, right? So how is this affecting your manufacturing costs?
Well, our costs are going up, but so are all of our competitors' costs. Everybody in the industry is being impacted by these tariffs. Now, we each get a different mix of them because we source from different countries in different ways, but we're all global companies, so we all have this impact. What I would just point out to your viewers is that where the cost comes from is different than how we handle it. So we may have certain products coming in that incur a certain cost. We add all that cost up and we say, okay, that's a bucket that we've got to manage. Then separately, we work with all of our suppliers to figure out how do we take cost out of our supply chain between our factories and our suppliers. We do this Project Reimagine, take $200 million out of our own costs. So we try and get the cost down as best we can. Then finally, we may have to put price in the market at certain points. But that's also a global picture. We're going to look to where we can put price in the market because we're adding enough value and the market can support it on a global basis, Europe, South America, and so on. So it's a more complicated, but it's a broader picture for us to manage than some might think. And so I'm comfortable we're going to manage our way through this. So and even in the U.S., the administration understands the farmer segment is super important,
right,
and they're going to do what they need to make sure the farmers stay viable and profitable.
So ultimately, is there a way of quantifying how much tariffs are costing the company?
There is. We don't make those so public, but we know exactly what it's costing us, and we have this huge spreadsheet where we have every component, every machine, where it's coming from, where it's going to. We can change the tariffs amount day by day wherever it changes, and it calculates our total costs either for this year or as a run rate into next year. And we actually also model that for our competitors to understand how the overall market might behave. I think they're doing the same thing. So we're all managing this in a very robust and professional way, and I'm confident we're going to make our way through this just fine.
Eric, good to see you. Thanks for joining us.
Good to see you again, Julie. Thank you.
Coming up, Coinbase shares are slumping amid disappointing revenue numbers. We will dig into that and tell you why maybe you should be buying or selling this one with an analyst. That's next on Market Catalyst.
Welcome back to Yahoo Finance. I'm Brooke DePalma, live at the NASDAQ. Let's get a quick check on the market action about 2 hours into today's trading session. We're still seeing this right across the board here. If we take a look at all three major indices, we're seeing the Dow down more than 600 points. We're seeing the NASDAQ also moving lower, down more than 2%. This is the first time we're seeing the NASDAQ down more than 2% really since Liberation Day back in April when Trump initially announced those trade headlines. Of course, we got new ones just late Thursday night. Investors certainly reacting to that. The S&P 500 also down more than 100 points as investors digest all the things, the latest headlines from big tech as well as the latest headlines when it comes to Trump's trade deals that put in tariffs from 10 to 40%, upwards of 39% for a country like Switzerland. And we're seeing Amazon really leading the decline when it comes to the NASDAQ after they reported Q3 operating income guidance. That was not what the street wanted to hear when it came to their Amazon Web Services. That stock falling in these early hours of trading, down nearly 8% after there's some momentum that we got just yesterday as both Meta and Microsoft really put out these strong cloud service numbers. Investors certainly not pleased when it comes to what they put out. Apple also losing the momentum that we saw in early hours trading here. As you can see at the open, we got a bit of a green after the company said that they beat the forecast for iPhone revenue, and now investors reacting as we're getting these latest trade headlines as well. Also, I do want to note here that it's not just here in the U.S., but across the globe, we're seeing this sell-off as investors really try to understand and digest what exactly these latest trade headlines mean. It's important to note here that what was announced last night does not go into effect now for the next 7 days based upon midnight tonight. So more negotiations could be underway. But really what we're seeing here is this major sell-off. Of course, also important to note here that we got weaker than expected jobs data from July and also a revision from back in June that might signal a rate cut come September. But keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout today's trading session.
Now time for some of today's trending tickers. We are watching Kimberly-Clark, Roku, and Joby Aviation. First up, we got Kimberly-Clark, the parent company of brands like Kleenex. The share's jumping. The company raised its full-year guidance after reporting the strongest volume growth in 5 years, backed by the introduction of new products that appealed to buyers navigating economic uncertainty. Back with us to discuss our own Brooke DePalma. And Brooke, it's been really interesting, the sort of personal care and consumer goods this reporting season, because they've been sort of various.
Yeah, here and there, we're hearing these different signals that the consumer is still willing to spend on essentially things that they need. Of course, Kimberly-Clark behind things like tissues. You're not really going to pull back if you want to buy tissues, maybe a few less boxes. But what we heard today on the call is that consumers are seeking better value or trading within our portfolio. We know that we heard that from Procter & Gamble, that switch between maybe Tide Pods to Gain detergent. They went on to say that in North America, they're seeing purchasing power under pressure for consumers. They expect that to continue. It's also worth mentioning here that Unilever is another company that we're seeing their stock in the green today. And it really is this notion that these are key staples, so to say, that make up Americans' households and not necessarily items that maybe company or consumers rather are choosing between here and there. And so we're seeing Kimberly-Clark up today, but it's important to note that over the past year, that stock has been down nearly 6%.
And next up, let's talk Roku. Those shares slumping today despite reporting second quarter results that beat expectations as well as raising the full year forecast. However, the stock was up more than 70% off an April low, so coming in hot to this report, even as those shares are now down 13%, Brooke.
Yeah, we're seeing a bit of margin compression that has investors concerned when it comes to Roku. Of course, there's lots of momentum behind the stock. We know that they recently announced a deal with Amazon that could ramp up. We also know that as consumers really switch from that cable TV to streaming, investors are seeing lots of optimism around what Roku is and could be. But it's worth noting that this stock, if you take a look year to date, it's up about 24%. And there's lots of momentum about this switch to streaming, this deal with Amazon, and all these other, momentum behind the streaming services right now as well.
And finally, Brooke, let's talk Joby Aviation striking a deal with defense contractor L3Harris, the air taxi maker looking to create a military-grade version of its commercial aircraft. Those shares not up huge, though, but that one has been sort of, I won't call it memey, but it's been kind of one of these ones that retail investors have been watching closely.
Absolutely. Year to date, Julie, this stock is absolutely soaring. It's up more than 100%. And year over year, this stock is up more than 200%. And albeit it's about $16.85 now, but that's just off a 52-week high, according to Yahoo Finance data, of about $18. And it's worth noting that, like you said, maybe in the meme sort of trade here, because when you look at the sell-side analyst coverage here, it's actually not too many analysts have initiated coverage. Right now on the street, there's 3 buys, 4 holds, and 2 sells. And so this is not a company that has, many analysts really covering it, but there has certainly been this momentum as they've announced these key partnerships as they get underway.
Thanks a lot, Brooke. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Coinbase is sinking after second quarter revenue missed expectations, with subscription revenue failing to offset weaker trading volumes. Joining me now, Dan Dolev, Mizuho America's Senior Financial Technology Analyst. Dan, it's good to see you. Thanks for being here.
Of course.
So there's sort of a disconnect here. If you didn't know anything about Coinbase and you woke up and you said that the numbers missed, and yet you looked at what crypto prices have been doing, you might be surprised. So what was going on here?
I mean, volumes were weaker, right, than people were expecting, and I'm actually quite surprised because you can actually track those things pretty nicely. And I mean, there's really nothing wrong about this quarter, but I think what was missing from this quarter a little bit is the element of surprise. And remember, the stocks had a massive run up until here, so I mean, I can see why there's some, air kind of blowing out of, coming out of that balloon. In this quarter, but really nothing wrong with the quarter. I mean, they're doing great.
They're doing great, but you do, if I'm not mistaken, you have a neutral rating on the stock. What's going on there? Is it and does the drop today make you maybe a little less negative?
I prefer, so if you think about the way we think about crypto, I mean, again, we look at every stock individually, but I prefer Robinhood. So if you think about sort of the exposure to crypto is good to have, but it's like chocolate, right? You don't want to have too much of it. You get too much of it, you get sick, right? So that's why we prefer Robinhood. You've got like 20-25% exposure to Robinhood and to crypto, and like 75% that's not crypto related, right? So with Coinbase, every movement on crypto, everything that's happening in crypto, and by the way, they're going the other way. which maybe feels like it's sort of a Me Too trying to get, take a page out of, Robinhood. So maybe the market doesn't like that. It's sniffing it out a little bit, not that they're getting into equities and into futures. So I think there's a little bit of that, but overall, it's not bad, but there's just like not that much. The element of surprise is kind of missing from that. And I think that's why we are a little more kind of reserved on that. Neutral. We're not too negative. We're not too positive.
Dan, as you mentioned, they're trying to push into some trading of some other asset classes, and also into tokenization, right? Tokenization of assets. What do you make of that whole trend, and do you think that is going to catch on, both for Coinbase and others?
I think it could be bigger than equities, right? And I think Robinhood has been proven to be sort of the leader of the pack there. I mean, with that event that they did at the end of June. Coinbase is also doing that. But if you think about this, there's like an enormous appetite for investors to invest in private assets, even institutional investors that I talk to, like my clients, and they just can't do this. And especially outside the US, it's even more difficult to do that. So if you're able to put it on the blockchain and let someone own a share of a private company, it's just like, expands the TAM like dramatically for everything. And also companies are taking longer to go public. This is another trend where, you're seeing like Stripe, right? They've been, private forever and everyone's like, when's the IPO? When's the IPO? Now you can invest in Stripe privately, which you couldn't do before. So I view this as a massive leap in sort of the evolution of trading.
So interesting. So because I think some have proposed a tokenization even of things that are already public, like equities, but it sounds like you think the real opportunity is more in private assets.
Great question. Private assets, real opportunity, both US and outside the US. Stocks, mostly outside the US, because there's really not much to improve. I mean, Robinhood, for example, almost they let you trade equities in the US for free. So let's say you're offering, tokenized stocks, like public stocks in the US. I'm not sure what problem it solves, but outside the US, think about it, like trading commissions are very high. You have to get on the brokerage stack. Like this thing just like lets you get off the brokerage stack, makes everything quick, efficient, cheap. It's a huge innovation for people wanting to invest in US equities outside the US.
And Dan, finally, obviously we've gone a little bit afield from Coinbase, but I am also curious to ask you about some of the recent sort of policy adjustments the SEC has announced with regards to crypto and securities definitions, et cetera. What are the implications then for the companies you cover, like a Coinbase or a Robinhood?
Everything in this administration and sort of the people that work for the administration have been phenomenal for the industry, right? They talk about the prior administration's war on crypto, right? I wouldn't go that far. They're just trying to regulate things, so I'm not of that camp. But lawsuits are being dropped. Genius Act, SEC, everything seems to be very conducive to the industry, and that's why you're seeing some of the fear factor on, the regulatory side being kind of subsiding. So I view this very positively because, we love when, our buys are going up and when the market's doing well. So this is good for us as well.
Dan, really quickly though, obviously some of this is being priced in at this point. So what then would be a catalyst for another leg up, either in the underlying assets or the stocks?
For Coinbase specifically?
For Coinbase, for Robinhood, for Bitcoin, you name it.
You would need, it's a really good question. I think the next leg up on this one, and again, I'm not a predictor. I don't have my crystal ball with me today, but I think for the next leg up of this one, you need maybe some sort of, interest rate. I think a lot of it has to do, I think people don't realize it, but I think a lot of it has to do with, rates and the expectations of rates cuts and macro. So I think for that, you need maybe macro certainty into the second half. And I think that could be very, good or bad for the crypto. So I think that's what's going to drive the risk appetite. And remember, crypto is a risk asset. So that's going to sort of flow through as the risk appetite goes on.
Gotcha. All right. Well, that's a pretty good crystal ball, Dan. Thank you. It's good to see you.
I underpromise and hopefully overdeliver.
Yes,
hopefully.
I like it. All right, coming up next, Stocks in Translation with Jared Blickery. How does the QQQ stack up versus the SPYs? We'll discuss next on Market Catalyst.
Earlier this week, we took a look at ETFs versus mutual funds. And today in Stocks in Translation, we're going to explore two of the earliest ETFs, SPY and the QQQs, and how the asset class has evolved over the last 30 plus years. And first, a recap of the definition of an ETF. These are shares that trade like a stock, but usually represent a basket of assets tracking an index or a theme, though there are exceptions recently. Unlike mutual funds, which trade only once per day after the close, ETFs can be traded bell to bell like a stock. Now let's take a look at a timeline that begins in 1993. That was the birth of SPY, and that's what this chart up here is representing. Now this came to pass in early 1993, and it was kind of the holy grail because there had been attempts before to create an ETF, but they had been struck down by the courts. So in 1993, SPY is born, and now you can trade the entire S&P 500 just like a little stock with a low amount of money. Then a few years later, in 1996, we get open-end ETFs, and this is different from the way SPY was constructed. It was a closed investment fund. That makes it more difficult to swap out the shares. But even though these open-end ETFs got the green light, not all ETFs would use them in the years to come, and I'll come back to that shortly. Now, in 1998, at the end of the year, we got a very tax-friendly ruling from the SEC, and this has to do with the way that shares are sold or swapped in. Now, in a mutual fund, if you want to change out a share, then you have to sell the stock, and it actually creates a tax event at the end of the year. So you could get a bill for that, but not in ETFs. They can usually avoid that. So that was a critical distinction that made ETFs more favorable than most the mutual funds when it comes to those taxes. Now let's take a look at the Q here. This launches in May or March of 1999. Kind of a big day there because now you could trade the NASDAQ 100 as the dot-com bubble was still going up. It would have another year or so, and then we would see that nasty fall. By the way, the NASDAQ 100 ETF QQQ, that would lose about 82%, and we'll get to that stat in a second. But fast forward a few years, and in 2004, we get GLD. This is the first physical gold ETF, and the first time we've had a commodity in ETF form. Quickly thereafter, we would get SLV for silver, but then we get others for wheat and coffee and all kinds of different things, all kinds of different derivatives. And then a few years later after that, we got active ETF managers in the game. So now this is kind of like hedge fund territory. This came in 2008, but by the time we got into the mid-teens, Cathie Wood would use this for the ARK Innovation Fund, and she would actively manage that ETF, kind of like a hedge fund. Now we're going to skip forward a few years in time, and let's see, we just did that one. Here, we're going to go to the end of the teens here, and we have semi-transparent ETFs approved. So for some of these active funds or actively traded funds, if you wanted to protect your secret sauce instead of disclosing all your holdings at the end of the day, this would allow you to do that, and that would kind of pave the way for some more active ETFs in the coming years. We still have mostly passive, but it is an improving game for the active managers. And then taking a look just a short time later, we have the ETF rule arrives. This was kind of like the holy grail for ETFs because previous to this, it was very difficult to get these things launched. You had to apply for regulatory relief, and this just streamlined the entire process. And this would really explode the ETF volume, the new ETF launches over the next few years. Finally, not finally, but almost to the end here, we got 2022 single stock leverage ETFs and also inverse ETFs. Those would join the game. Tesla, Nvidia, Broadcom, you name it. We now have, I believe, close to 100, if not more of these. And these are tracked by our friend Todd Sohn over at Strategas ETF Management. He comes out with some interesting figures each week on that. And then in the beginning of 2024, we got those spot Bitcoin ETFs. Prior to that, we had Bitcoin ETFs that were based on futures, but these would really allow investors for the first time to track the actual price of Bitcoin in their 401ks and just have access to it like any other stock. And the last item here, this is not a big sweeping, but this is not a big sweeping change to the industry, but Invesco is asked to convert the NASDAQ 100, and that's its Qs fund, tracker from a fixed unit investment trust to an open-end ETF so that the firm, not just the custodian and NASDAQ, can share in the fees. And this goes back to that early decision in 1999 to form it as a unit investment trust, which is a closed-end fund instead of an open-end fund. At the end of the day, Invesco has left hundreds of millions of dollars on the table because of that, but we'll get to some details on that in a second. Next, I want to show you the differences between SPY and Qs over the year and some of the different stats that have evolved. So we've already covered the launch dates, but look at the total price return of SPY. That's up over 1,300% since 1993, and since 1999, we have the Qs up 1,007%. When it comes to the worst sell-off, that would be the global financial crisis, minus 56% for SPY. And then, I think I cited this before, 83% in 2000 to 2002 for the Qs there. That was the dot-com bust. And if you take a look at the management fee, basically half for SPY, that of the Qs, 0.0945 if you're going to add a few decimal points. And the volume on SPY, I believe it's still the heaviest traded ETF in the solar system, 67 million shares per day versus 40 million for the Qs. And then if you were to convert that to a dollar amount, that's 42 billion every single day, and about half of that, or 23 billion, for the Qs. Now, the shareholders of the Qs, they're going to vote on October 24th whether to modernize the ETF. And if they say yes, then the trust becomes an open-end fund, letting Invesco keep most of the management fee, worth over $600 million a year based on today's asset base. So if the shareholders give the green light, the changes could go into effect in early 2026. And tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found every Tuesday and Thursday on Yahoo Finance's website or wherever you find your podcasts. And guess what? We got more market catalysts after this.
ExxonMobil and Chevron's profits hit four-year lows in the second quarter thanks to lower crude prices during the period. Still, both companies' earnings beat analyst expectations as oil production neared records. Joining me now, Fernando Valle, Hedgeye Risk Management Energy Analyst and Yahoo Finance Senior Markets Reporter Ines Ferre. Ines, let's start with you. What were your biggest takeaways from these results?
My biggest takeaway was with ExxonMobil that Darren Woods talked about or hinted at the possibility of M&A activity. So he hinted at strategic M&A moves. He said, I think there's opportunities for them to see if these come to fruition. So this is interesting that he is openly hinting at this. And then we would see perhaps more M&A activity, which we have seen already in the shale space over the last couple of years. The other also point was with Chevron. Of course, the Hess deal that has come to fruition and that has closed, and Chevron also incorporating Hess into its free cash flow forecasts. So those came in better than expected. The street was happy about that. And then another point that I thought was very interesting was the talk about AI tools as well from ExxonMobil, from Darren Woods, and talking about AI in order to lower costs and perhaps to even make it cheaper to find oil. Those were, I think, were some of the interesting points. There were many, of course, in the space, but those were some of the highlights that I saw.
Yeah, most definitely. So Fernando, let's bring you in here. In an environment where we have these lower oil prices, these companies have already been so acquisitive and raised production so much in order to make up for those lower prices. How much more room do those trends sort of have to go?
Well, when you look at the Permian specifically, over 50% of the Permian is going to be controlled by its top 5 producers, of which Exxon and Chevron are 2 of those players. And highlight, Ines mentioned, Hess, Guyana, which is the prized asset within the Hess portfolio. Exxon and Chevron are now partners in that project, combining for 75% of that project. That's probably the biggest growth outside of shale in the next couple of years. So they are already the juggernauts in both the 2 main growth areas outside in the world. There's limited amount, but they can still add at the margins. And there's certainly several small E&Ps in the Permian. There are also private equity-backed assets in the Permian, and then an emerging play in Argentina, the Vaca Muerta play, where Chevron and Exxon are already present, but that is seeing a lot more development.
So volume is part of the game, production part of the game, and then margins are another part of the game, of course, Fernando. How much more cost do you think, from AI or whatever it is, whatever measures and tools they use, how much more cost do you think they're going to be able to take out of that production, wherever it may be, and increase the margins?
There's limited amounts, especially because this is a heavily taxed industry. So when you consider OPEX reductions, the actual impact on the bottom line is very, very small. And if you consider the first real oil price crash of this cycle is really 2014, 2015, when we were above $100 a barrel and then went to $30. This whole last 10 years have been about removing costs out of the equation. So you can make it a little bit more efficient, but the gains are going to be very small that accrete to your bottom line. It's really about making it slightly more efficient and potentially, as Inez mentioned, improving your possibility of discovering new oil or improving the amount of oil that you can recover from reservoirs.
Fernando, talk to us a little bit about the opportunity that these companies see when it comes to the natural gas space. Golden Pass LNG, that's the Texas project, the export project that was mentioned during the call. Talk to us about the not only the exporting of liquefied natural gas, but also natural gas when it comes to using it for things like data centers, for example.
Yeah, that's a great point, Inez. There's on the LNG side, these are two of the leaders already. Reminder, Exxon owns Qatar Gas, a part of Qatar Gas, the largest exporter of LNG in the world. They have large LNG projects, Chevron and Exxon in Australia, in Papua New Guinea. There's a lot of projects already in the hopper, and you mentioned Golden Pass that is going to be built 27, 28, depending on the delays there. But the interesting part is really on the upstream side, because Exxon specifically had sold some of its dry natural gas, like the Barnett Shale, some of its Utica holdings, to focus on the oil part of the equation. But when you produce oil, you also produce a lot of natural gas. So it's interesting to see that they are concentrating their investments in the Permian and trying to create a corridor between the Permian and those Corpus Christi, Houston, to export that natural gas, and focusing less on the dry natural gas basins, like the Marcellus Utica that I mentioned, or the Barnett. Data centers are an option, especially in the Permian, where there's a lot of stranded gas. The Waha hub in the Permian is constantly at 1 to 150 per MBTU, sometimes even going negative because there's too much natural gas there.
Fernando, Inez, thank you so much. Appreciate it.
Pleasure.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance coming up.